So for let's say like you're from US and you want to build a constructive portfolio, right? So so how can you build that? So now the time horizon. Let's say I'm thinking your time horizon is not short term. Let's say it's long term, 5 to 10 years. Then I would choose this portfolio, right? You're conservative, meaning you you have very low risk tolerance. So therefore, yours should be some can go here, but like since your time horizon is little bit farther, like 10 years, then you can slightly dip into mid level risk item as well if you're conservative, given that your time horizon is big. But larger part of your portfolio will be on the low risk item because you're conservative. You don't want to lose. So what is conservative? Conservative are people who don't want to lose their money at any cost. They want to preserve their capital as much as they can. So with that in mind, with that in mind, now considering the time factor, which is of 5 to 10 years, it makes sense to put some money in a not stocks, but at least a mutual fund, equity mutual fund, or something with low less riskier mutual fund, right? Like not like highly uh, you know 3 time levered ETFs or nothing, like simple ETFs with low risk as possible and cheapest, right? And then 5% cash, because so my mix would for this type of person would be 55% bonds, 5% cash, and 40% index fund. I would just go for an index fund in this case, a low cost index fund. We will get to that in a minute. So as I said, like they want to conserve their wealth as much as possible. So therefore, you would go and invest in bonds, right? Now, now, first of all, you need to understand what is bond. So this is investor .gov. It's a US SEC, Security and Exchange Commission, has given some definitions for it. So basically, a bond is a debt issued by somebody, because they want to have this fund to, let's say construct an infrastructure. Let's say government wants to put together a road. They want to, you know, they issue this bond, uh, and then what the issuer do, the issuer can be government or corporate, right? It can be any of those. And they what they promise is they typically pay you a specified rate of interest during the life of the bond, and to repay the principal, also known as face value or par value of the bond, when it matures or comes due after a set period of time, right? So as simple as that. So basically, they will pay you a specified rate and also the principal back when the bond matures. So maturity comes with a specific timeline. So they will give you, okay, you need to keep it for like 1 year. Why do people buy bonds? They provide predictable income stream, so they may give you like regular interest income, and then you can use to whatever, right? If the bonds are held to maturity, bondholders get back the entire principal. So bonds are a way to preserve capital while investing. So basically, it gives that cushion you, because conservative investor, they don't want to lose their capital. So the bond provides a good mechanism to preserve the capital while investing and giving some interest as a rate of return. Bonds can also can help offset exposure to more volatile stock holdings, right? So basically, they are kind of, even though they say that, it's kind of like, you, because if you think about it, they have maybe low low or they can bonds can also be categorized as uncorrelated asset when it comes to stocks. Therefore, like let's say, like for example, if there is stock market has to crash, a lot of people try to go and hide in a safe investment, and in most cases the safest investments are, you know, government bonds, like such as us treasury bills or us bonds, right? Because it's backed by the us government until they default, which is highly unlikely. You know, you're supposed to get your money back. So a lot of people flock, so therefore, you know, this, it balances your portfolio, right? So so who can provide bonds? Company, governments, and municipalities, right? So they can invest bonds. And what type of bonds are there? So there are many different types of bonds. I just talked about us treasury bills. So, you know, which is where people, you know, go offset exposure to more volatile stock holdings. So usually, you know, it's people go and invest in some of the US government bonds, right? There is also corporate bonds and high yield bonds, and investment grade bonds. So high yield bonds are usually junk bonds. You know, they have low credit rating, but they can provide you high yields because, you know, it's not trustworthy. So, you know, in order for it to, you know, get more investors, they need to pay more interest, right? Otherwise nobody is going to buy them. So, but there is a high chance that they may default. These companies may default, and then there are risks associated on that too. So we will get to that. So what are the types of bonds? Corporate bond, investment grades, high yield, municipal bonds, US treasuries, so on and so forth. So what are the benefits and risk of the bonds? Bonds can provide a mean of preserving capital, earning a predictable return. We talked about this, and that's exactly what a conservative portfolio needs, right? And what are the various risks? Credit risks. And credit risk is what I just talked about. You know, some issuers may fail to timely make interest or principal payments and thus default on bonds, so which is typical with high yield bonds. So, right. um, Interest rate risk. So for example, currently at the time of recording, this video is made on 2022. So there is, you know, that um, you know, currently the inflation is too high. The Fed is increasing the interest rate. So think about, I go and buy a bond today, and 2 weeks or maybe like a month after Fed increases the interest rate, my bond may give you, you know, low return when compared to the newly issued bond out there. So the interest, so you know, if the interest rates are kept, you know, increased, then the bond lose its value. So basically, then you have to sell your older bonds with low interest rate. You might have to sell it at a discount. So that's, these are the typical risk, right? Now, the reason I'm saying is, like, coming